Welcome to Erik Penser Bank. My name is Jonas. Thulin. I'm head of asset management, and I will try to briefly go through our house view and how we position. This is the day after, we're recording this on Thursday, the day after the Fed, and we were quite surprised yesterday. We received a lot of messaging from Powell in terms that long-term inflation expectations are well anchored. They will cut rates long before the CPI now is at 2%. When they think it's heading towards 2%, they will start cutting rates. They did not change the long-term forecast for either unemployment rate or inflation. And at the very end of the press conference, Powell started to discuss the housing market and the potential pains, and that's what really dominated the equity market after that volatile session. As such, we think the first part is a lot more important than his comments about the housing market. Given the sort of free option of hanging on to a lot of equities in our portfolios, given the fact that rates are equal or even worse, we will not change our asset allocation. We show here that despite that we are maximum overweight equities, we're actually beating our listed competitors that are underweighted equities and rates. And the reason is quite simple. It's easier to hedge and work with equities than with rates when both perform equally as bad. We think we have a free option to use in equities. So when we look at a 60-40 or 40-60 portfolio this year, obviously they are performing equally bad. But for the past 3 months, our global equity portfolio is actually up by 7%. And this is due to very fine-tuned investments in biotech, in India, in clean tech, in Latin America, in Brazil, and also with various different currency exposures here to really take full advantage of the fact that the Swedish krona is plummeting, which it should, given what we're doing in this country, which I'll come back to with this quite interesting interest rate hike that we have done as a country. So we're still pro-risk in that sense. We don't care too much about indices. Obviously, we work with our actual portfolios, and we're keeping a good distance to the June lows, which we think is quite interesting. Now, in terms of global equity performance versus a benchmark, we're obviously outperforming, and we're really not losing too much momentum or area versus global equities. What we think is quite interesting is to study paradigms, and we've been shifting through a number this year. We started off with a huge R-square, i.e. statistical explanatory power between US political risk and equities. That was shifted into a geopolitical risk and its relationship to equities, given the fact that we obviously went into a war in Europe. And then obviously that spilled into an inflation risk, which dominated equity markets in March. And since then, we've really been dominating, or lately, been dominated by financial conditions, i.e. rates going up, what's going to happen to the equity market, la-da-da. But as you can see, that relationship is actually falling each and every day now, and it's being counterweighted and built up from a daily updated macro models and macro data, which we think is really interesting, given the fact that the macroeconomic releases are surprising positively in the US for the time being. So for us, we are happy to focus more on macro, but it also is a good reason to hang on to equities, which really sounds a lot more difficult than it really is, given the fact that rates are equally as bad, and given that we can use currencies and very fine-tuned investments. We're not all that concerned. We're down on the year, but a lot less than the index. We believe that, given what Powell said yesterday, it was a clear distinction on that we have reached peak hawkishness. We do realize this is not the consensus view if you look at media as such, but we also know that media has a strong tendency to be overly pessimistic, which we really don't care too much about. But we think that we have reached peak inflation. That would translate into peak hawkishness. We think that Powell hinted very well yesterday, and you can see that in the equity market reactions to what he said, even though at the very end he made his comments about the housing market. And growth, and I will come back to that again, the importance of growth, obviously. If you look at the last bullet here, or last paragraph, we don't think we're going to have a US recession in 2022. We were right on the earnings rebound in Q2. We were able to make some good strides there in the equity market, and we think Q3 will be equally positive forecasting, and the outcome will be equally as positive in terms of earnings surprises. We're still a soft landing versus hard landing. Remember that the Fed forecast for unemployment rate stopped short of 4.5%. The reason is that their own definition between a soft and hard landing, which is 4.5%, so 0.1% on the good side. So we'll see if that holds. If it holds, it will be great. They didn't change the long-term forecast, which makes sense. And I wouldn't argue it, therefore it's all transitory, but it's interesting to know that the increase in talk about deflation in the market that we're experiencing right now. Obviously, price inflation peaked in March. We can see that the amount of money spent on petrol stations is falling lower and lower, which is quite good for inflation. If you look at the 5-year break-evens, we can actually see that we haven't really moved above 2.5%. We're stuck at 2.2%. Which is quite interesting given how the market is looking at the cost pressure and everything is evidently going to roll over. And again, Fed's own forecast is that we'll be down to 2.8% next year, which is bang on line with consumer expectations for next year. So this whole inflation monster seems to be beaten already. If you look at used car sales in the US, we used to have a year-on-year effect of 40 to 45% if you look at the months of February, March and April this year. Now the last year-on-year growth number has gone from 45% upside to 0.5%. So we dropped 44.5%. Inflation is simply gone in that category. And I think this is how fast things will unravel on the CPI. Obviously, commodities is playing along, 5-year swaptions playing along, supply bottlenecks playing along. It's really difficult now to start to find data that's not playing along this. Pricing plans, which also Fed was alluding to, where you can see lower and lower price or wage pressure, is obviously also playing out. You can actually see that a lot of wage data is peaking out, which is quite interesting. And the Fed is now, which I think is the first time that I can remember at least, that the Fed's one-year forecast is bang on line with consumer one-year forecast, i.e. CPI will be 2.8% next year. So a little bit lower, but also in line with what we saw in 17, 18, 19, which is pretty interesting. And I think that's why obviously Fed is already arguing for 70 basis points cuts in 2024, but some also arguing for 100 basis points. If you look at the break-even curve, you can see the downside as well. So this whole idea of peak inflation is something we stick to. And another thing that we want to bring to your attention is that inflation is not inflation. With that we mean if you look at Swedish inflation and compare to the US, we can see that in the US you have a demand-driven inflation. In Sweden you do not have as much demand-driven inflation. The gap is actually 140% of more demand-driven inflation in the US, which means that in the US you can hike rates and trying to get rid of that excess inflation, which you can see also in consumption, in wage income, in unemployment rate, etc., etc. In Sweden, you're hiking rates on a supply-driven inflation spike, and you can see that we already have the lowest retail sales on a year-on-year growth since the financial crisis or the 90s crisis. And we also have a record indebtedness and a falling house market, etc. So the conditions are completely different, which is why I think the market dumped Swedish krona as soon as they hiked. You would imagine that the Swedish krona would actually be a bit stronger given the fact that the hike 100 basis points, which was not in the market, so that should sort of have strengthened the krona. I think the market is perfectly right in doing the opposite. This is no good news for Sweden. The easiest way to hedge this or position on this is to sell krona, and actually even our pound stock trade is now making money. So it's quite interesting. Peak Åkersnäs, yes, we can see the peak is going to be a very short peak before we start to see cuts in the US, a lot faster but also higher peak than we saw back in March. The long run forecasts are stable. Again, this magic number of 2.5, which is quite interesting for the Fed, which is where the 5-year break-even is already trading this. So it's clear that peak Åkersnäs is just a matter of timing. We hope that the timing from June will hold. If not, we will change our positions, but not until then. A little bit disturbing or stressing, I think, is that there's a lot of talk about African American unemployment rate. And if you look at those three categories that the whole new school of thought in the Fed was meant to help, i.e. African American unemployment rate, low wage earnings, and no college education earnings, you can actually see the Fed should even start to cut rates. But obviously the hiking, i.e. repeating what we saw at the end of the 90s or before the financial crisis. This is obviously nothing they're proud of, because the next time they're going to go out and say that they've been rethinking and reworking their mandate to the degree that they can do that without the legal approval. I think the market will be quite skeptical towards that. If you look at the language the Fed is using, you can actually translate that through natural language processing into an equity indicator. This is a bit iffy, to be perfectly honest, but I think it's quite interesting to have a look at the minute sentiment score. And it's at least harder to argue that the equity market will fall compared to what it was when we went into 2022. So that's an interesting indicator. There's nothing that we trade on, but I just thought it could be interesting to have a look at that through natural language processing, you're not as hawkish as you were going back a couple of months. In terms of financial conditions in the US, which is losing traction versus the equity market, you can see it's neatly balanced in the US. It's negative, i.e. it's contracting the economy, very balanced, very sort of mature process. In Europe, we sort of lost the grips on this a little bit, not to mention Sweden, which I will come back to, but it's a completely different outlook. Simple conclusion, don't own equities in the Eurozone. Remember also that the US is hiking rates when their debt level is at the 80s level. And 80s is coming back all in music and all fashion, also come back in terms of indebtedness in the US. A completely different picture if you compare this to Sweden. I will come back to that. Also, do not forget that the bank deposits in the US, if you compare to where we are with the linear trend, you can actually see that we have a couple of $1 trillion just sitting there in the bank accounts. Obviously, that's the checks from the pandemic stimulus checks. But it's quite interesting to remember that when we're hiking rates, we do not have that buffer or crash pillow in Europe or Sweden. This is just debt service ratio in the US, which obviously is very, very low. So we're quite happy to hang on to equities for the time being. Now we've been breaking a bit lower in terms of our risk model, which is obviously nothing we think is great fun. Our immediate action then is to reallocate. So we sold off a little bit of tech that we were US tech that we were trading through Europe, Europe exchanges, I should say. And we shifted into a US traded biotech strategy. There will be more information there coming up later on. So we have acted on this. We haven't taken down the risk, we have reallocated the risk. Why we haven't taken it down is that we still, when we look at our daily trading model, we still see ample of buying opportunity if you look at counterparty risk, dollar liquidity and vol curves. Similar to what we saw in the June rebound. So hopefully this trough holds. It's definitely holding up for us. It's another thing in terms of broad indices, but it will be very constructive if that holds. If it does not hold, we will act there and then, but given this model, that's where we put our chips and our risk, of course. It's also quite happy to notice that the smart money index is also positive, i.e. we have a lot of institutions buying more so than retail, which is also a good fun signal. Another good fun signal is this a bit weird looking graph, but in end of 18-19 in the pandemic and right now in the last couple of months, we can see that institutional equity sentiment is a lot more positive than retail. That has led to troughs in the equity market in the past, and hopefully it will hold this time as well, and we will act accordingly. The put-call ratio is also showing signs of a trough, which is good fun. The Goldman Sachs bear market indicator is showing actually very constructive signals. Here we look at the PE number, rate curve, CPI, and employment rate, and ISM. And those factors are not really building a bear market probability on the downside, rather the opposite. So it also, perhaps not on magnitude, this indicator is the most important, but also in terms of direction, I think it's quite helpful. Another one of those weird looking indicators is the Hubel liquidity ratio, which we can see that we're building lower troughs, or higher troughs I should say. And right now you actually see almost a net positive in terms of buying the equity market. So we see a lot more buying interest compared to the bottom in June, July, which is quite interesting. Hopefully that holds. We're still in growth. It's an old news, but growth to us is not from a French growth. Growth to us is clean tech, it's cybersecurity, it's semiconductors and so forth. And actually, semiconductors, cybersecurity and clean tech was up for us yesterday. So even though that was a tough day for the equity market on index level, there were value to be found there, especially if you look at Latin America, which is up today again. So there are pockets of strength out there that we need to find. We believe that even though if we go into a recession, the market has already priced it. So it's quite tempting to start to think about this as a 94, 95, 96 event. The equity market is bearish, and then the economy rolls over, but then the equity market is done, so it rallies in the face of recession or sharp slowdown in the economy. And it's quite interesting now that the equity market has priced again the recession. The recession isn't really happening. And by the time it is happening, i.e. late 2023, going into 2024, which is where we have it penciled in, you can actually see the equity market coming back again because it's already been priced. So this type of weird correlation thing that looks almost like a weird looking figure eight is quite interesting rather than this more odd correlated events that we've seen or grown accustomed to as of late. So it's a little bit, it's pretty interesting to see where this is happening, and especially in an environment where earnings estimate revisions are troughing. There's a lot of talk about earnings estimates should be coming down, but I would like to remind everybody that in terms of earnings estimate revisions, it has already collapsed. It's actually the rebound that we're trading now. So this is a very interesting call, I think. If you look at will that rebound hold, I would argue yes. In this is a leading indicator of earnings estimate revisions. So we're trying to lead the revisions by simply looking at what are the corporates saying about their sales and profit levels, and compare that to the consensus of the very same corporates. You see this black line, and that's been a perfect guide so far in terms of the earnings momentum. So we believe Q3 will actually be positive surprises yet again. And another reason why we still like equities, of course. Another reason why earnings revisions is troughing is obviously the surprise index economy, which is slowly picking up. The second derivative is at least in our favor, and I think we're actually going to break zero here, and we are on some of these economic surprise data series. So it's quite interesting. And if we aggregate all this, earnings revisions, price target revisions, economic surprises, you have this indicator, you have the various time series down here, you can actually see that the risk or the potential reward of keeping equities, which we think is a free option given the fact that what's happening on the rate market, is actually quite constructive. It's not aggressive or weird in that sense. We're simply following earnings revisions, the trough in that, price target revisions, the trough in that, and our economic surprises, which are actually growing positively, and I will show you a bit more detail going further. So it's not that out of consensus, I would argue, in that sense, even though we're not really following the daily media chatter in that sense. The recession indicator is showing 25% recession risk in the US. A lot of the curves are inverting, but not all of them. Even if they are, remember that the lag between inverted curves and the equity market sell-off or recessions could be anywhere between 1 and 3 years. So in terms of trading, it's an interesting signal, but it's nothing that we take position on. If we were to pinpoint the timing, we will end up in late 2023 and 2024. And voila, that's what the Fed has found as well. And this is why they have a cut as much as 100 basis points in the dot plot. I shouldn't say 100 because actually the average is 70. But if you take 1 of the dot plots in the median, you actually end up at 100. So it's a very fine balance right there. In terms of recession risk, we see 22% if you look at credit spreads. And if you leave all the data mumbo jumbo, if you like, you look at hard data, you can look at ISM versus lumber pricing, you can look at railroad cargo loads, you can look at empty versus loaded containers shipped from US ports, you can look at Chinese electricity use, steel usage, cement usage, you can look at port activity again, or you can look at traded goods in volume between US and China. It becomes more and more difficult to find indicators that are negative, which is this is obviously inverted. More and more hard data is actually following. And so the recession call, which might happen, But it's not happening right now, which is why we think it's, especially then given the free option that the rate market is giving us, it's worth hanging on to equities. Another reason then why we're positive is the fact that daily updated GDP models in the US is still showing positive growth. And you have Goldman's indicator up here, which is still positive growth. And you can make a GDP indicator based on all these daily updated GDP growth models, and you end up with a very strong growth. So in terms of downside, now costing models updated on a weekly basis from OECD for the US, again, positive growth. If you look at Sweden, you actually have positive growth, but remember here that the Swedish economy is very divided between manufacturing industry and the private consumption industry. So if you look at US data, you can actually see that in terms of data that's defining US recessions, you can actually see positive growth there as well. And as I mentioned before, if you look at the economic surprise index, you can actually see in the very nitty-gritty level, you see all of a sudden positive growth. And inverted here is the recession risk, which is obviously then going to fall. Which is why the daily updated macro models are very important, because that's driving the market, and why we look at orders and conference board, and we will also look at Germany and Swedish retail sales and confidence numbers. Now, Swedish confidence numbers, we're starting at end, very, very low, very depressed, for a good reason. US conference board number, very, very high, almost weirdly high if you look at it versus University of Michigan. The reason is obviously different questionnaires. The University of Michigan is using a lot more inflation questions, but it's quite interesting to see the level of it. We think the order intake in US, or the order growth, it has to come down at one stage, because it's growing way too aggressively. And that could almost be something constructive for the market, I think. But looking at Germany, it's almost intriguing to look at Germany. Yes, we know in downsizing, but the economists that put a recession probability at 78%. We can't really see the data collapsing, arguing for that, yes, there will be a recession right now. So the question that starts to pop up in our minds is that we haven't shorted European or Eurozone equities. Is when will the market look at this and say, well, maybe we pulled this too far? Yes, we can see in ZEW that we will have a collapsing economy, but then we also have to remember that ZEW is a questionnaire filled in by market participants, so probably not worth too much. If you look at actual truck toll mileage data, for example, yes, as a counterweight, you can actually see it's growing positively right now. So in terms of actual what's happening in the real economy versus the consensus and forecast and what market participants expect, you have a completely different outlooks. Now, we think the situation is so unsure that we do not take a position on this, but I think it will become more and more interesting for the market to try to see if we can find value in Europe. Obviously, a peace proposal or something that would be a great catalyst, but I think it's worth remembering that we're bone-heartedly looking for a recession in Germany, 78 percentage point from our beloved economists, but we can't see it in actual data, which is it might come around, or it's a big not a hoax, but a mirage. Sweden, though, remember, the housing sector is what it is in Sweden. We've been arguing about this for a long time. It's a collapse. We have a real wage growth in Sweden, which is the lowest we have recorded. Now, retail sales in Sweden is already down at levels that we saw in the Great Financial Crisis and the 90s crisis before then. And as you can see, when the retail sales was growing quite strongly, we hiked rates, as we did in 99-2000, as we did in 2006 and 7. Even 10 and 11. But this time around, we're hiking rates at the same time as consumption has died away. And we already know that inflation in Sweden is not really demand-driven to the extent the US is. And we also know already that the debt service ratio before the hike, or the hikes, is at a record high level and almost record low level in the US. Now, clearly, the economic outcome in Sweden and the US will be greatly different. Our basic formula for handling this situation is to be short the Swedish krona wherever we can. And even our sterling stock is making money right now, on top of the NOK stock, Euro stock, and dollar stock. But it's also quite interesting to remember this when we do a single equity stock picking, which is quite interesting to remember that in this environment, which companies can actually have a good performance on a relative, maybe even on an absolute level, and who is sort of getting the sucker punch, and try to avoid that. Because obviously to hike rates in an environment where we have very, very low retail sales is a cruel experiment, I would think. It would have been more interesting if Sweden could do something on the fiscal side. Because we also have to remember that the systematic stress in the Swedish financial market is very high. It's higher than we saw in Italy or Greece. We're almost back to the Greek crisis level. This is nothing really being discussed outside the market, I think, but in the market it's heavily discussed. We will make a trade in the fixed income portions of the portfolios where we actually not only shy away from Swedish but also European debt markets. And we actually find better liquidity in emerging markets, certain emerging markets, which is not really the natural state of things, but it's a consequence of maybe too prudent regulations or whatever. But it's also interesting to know this is the situation even before we made this 100 basis points hikes in Sweden. So we're not too bullish on the Swedish consumer. Again, we have to be mindful on our stock picking in Sweden, which we are. And also we can utilize this in the sense of being short the Swedish krona. And also remember that Europe and the financial stress or systematic stress in Europe is very, very high and accelerating. It's high-ish, but also falling in the US and China. This is all taking place while global growth continues to grow. So it will be one thing if we're all in this global cyclical crash together, but we're not. Global growth is growing by about 4%. We can actually look at data from the Red Sea and see that if anything, global growth is actually picking up, and we have more data on that, and like the Chinese and US that we showed before. So our concern here is that what's going on in Europe? It could be that we will head into this 80%, 78% US recession risk, or it might not happen. The situation is so uncertain in terms of making conclusions based on data. So our simple measurement right now is to have zero exposure to the Eurozone in terms of the equity side and utilize the currency move that we've seen versus the dollar, basically. That is all. We will be back in a week's time. So I thank you so much for your patience and time, and I will see you in a week. Thank you so much.